Hey family, welcome back to the Imani Invests community. I want to start today by having a real, heart-to-heart conversation about a number that should make us all stop and think. According to the Federal Reserve, the median American between the ages of 55 and 64 has about $185,000 saved for retirement. Now, on the surface, that might sound like a decent chunk of change. But when you realize that most of us are going to live another 20 to 25 years after we stop working, the math starts to look very different. If you do that arithmetic on a napkin, you get a number that will make your heart sink. But here is the part the glossy brochures from the big banks never mention. There is over $49 trillion sitting in American retirement assets right now. The industry sitting on top of that mountain of money has absolutely no incentive to tell you the simplest truth: that the whole game can be won with just 2 accounts and one simple rule. They want to sell you complex fee schedules, managed accounts, and fancy risk questionnaires, but you don't need any of that. You need an account that costs next to nothing, a safe place for your cash that's earning about 4% right now, and the discipline to not touch the wrong bucket when things get scary. Today, I'm going to walk you through the exact dollar-by-dollar mechanics of what I call the 2-tank system. We are going to look at 3 realistic years of retirement, including a year where the market crashes by 20%, so you can see exactly why this works when everything else fails. I want to be clear, this is just a good idea I found in a book. This is a historically validated strategy that often produces better results than the pros, yet most people blow it when the pressure is on. It's not because the math is hard, it's because our brains are wired to override logic at the exact moment we need it most. Willpower under financial stress has a very short shelf life. Family. So we need a structure that makes doing the right thing the path of least resistance. Imagine your wealth as 2 tanks. The first tank is a large, mostly underground cistern. This is your growth tank. This is where your real wealth accumulates. In retirement terms, this is your equity position, like the Vanguard Total Stock Market ETF, or VTI. It owns a piece of roughly 3,500 companies across every sector of the American economy. It has returned an average of about 9.5% annually over the long haul, and it costs you practically nothing to own, about $3 a year for every $10,000 you have invested. The second tank is a smaller above-ground tank. This is your drinking tank. It is a money market account that holds about 4 years of your living expenses. Right now, in early 2026, these accounts are paying between 3.5% and 4% interest. The entire discipline of the system comes down to one phrase I want you to remember: drink from the small tank and leave the cistern sealed during the drought. To understand why this is so important, let me tell you about Robert. Robert was a diligent saver. He maxed his 401k for 30 years, stayed diversified, and arrived at age 62 with $900,000. He felt secure even though he was a bit short of the $1.46 million many people say they need today. He set up a monthly withdrawal of $4,500, which is about a 5% draw rate. But then, 2008 happened. The S&P 500 dropped 37% in 1 year because Robert only had one account. He was forced to keep withdrawing money from a shrinking pile. He was selling his shares at the exact moment they were worth the least. This is what we call reverse dollar cost averaging, and it is the fastest way to kill a legacy. By the time the market recovered in 2012, Robert's portfolio had been so depleted by those forced sales that it never bounced back. He died at 79 with almost nothing left, even though his money should have lasted into his 90s. Robert didn't fail because he spent too much. He failed because he drank from the cistern during a drought. The 2-tank system protects you from Robert's fate by accepting that the market will always be a roller coaster. We don't try to stop the volatility, we just build a way to live around it. Imagine you retire with $1 million. You need $50,000 a year to live, and $30,000 of that comes from Social Security. That means your portfolio needs to provide $20,000 a year. You put $200,000, that's 20% of your total, into your small drinking tank, the money market. The other $800,000 stays in the growth tank, VTI. In year 1, let's say the market is kind and VTI gains 7%. That's $56,000 in gains. Your money market also earned interest. You take your $20,000 for the year out of those gains, leaving your $1 million principal completely untouched. Your cistern is still full now. Look at year 2. The market crashes and VTI drops 20%. Your $800,000 is now worth $640,000 on paper. This is the moment where most people panic and call their advisor. But with the 2-tank system, you do absolutely nothing to your VTI position. You don't sell a single share at the bottom. Instead, you just keep drinking from your small tank. Even with inflation, you draw what you need from that cash buffer, which still has over $160,000 in it. Your growth tank stays sealed, quietly waiting for the sun to come out again. By year 3, the market bounces back 15%. Your $640,000 grows to over $730,000. You harvest some of those gains to refill your small tank, and suddenly, you've survived a major crash with 85% of your original $1 million still working for you. This is the power of the buffer. It's not there to get you rich. It's there to give your nervous system something to look at that isn't falling. The data on this behavioral gap is genuinely shocking. Research from early 2025 showed that while the S&P 500 returned 25% in 2024, the average investor only earned about 16%. That is a massive gap. Over the last 15 years, regular investors have consistently underperformed the market because they let their emotions drive their decisions. They buy when they re-excited and sell when they re-scared. A $100,000 investment left alone in the S&P 500 for 20 years would have grown to over $700,000. But the average investor ended up with less than half of that because they couldn't stop touching the sell button. I think about my friend Marcus, who retired right before the pandemic in 2020. He had 4 years of cash saved up just because he was nervous about the market. When the world shut down and the market crashed 34% in just 33 days, Marcus didn't even check his brokerage account for 6 weeks. He knew he was fine because his drinking tank was full. Being boring at the right moment is worth more than being a genius at the wrong one. Now, some people will tell you about opportunity cost. They all say that $200,000 sitting in cash could have made more money in the stock market. And on paper, they are right. The gap could be over $11,000 a year. But that argument assumes you will act like a cold, calculating computer. The 15-year streak of investors underperforming the market tells us that we don't act like computers. The two-tank system deliberately sacrifices a little bit of theoretical return to buy you behavioral stability. It protects you from yourself. So, how do you apply this to your life right now? If you are within 5 years of retirement and have a meaningful portfolio, you need to start building this structure today. Don't wait until the day you quit your job to learn how to leave your investments alone during a downturn. This is a skill, and skills take practice. If you are 10 to 15 years out, treat every market correction as a dress rehearsal. When the market drops 10%, which happens almost every year, learn to look at it like the weather. You don't try to negotiate with the rain, you just grab an umbrella and keep moving. And if you are further out, just focus on keeping 6 to 12 months of expenses in cash. Forced liquidation, being forced to sell your stocks to pay for a medical bill or an emergency, is the #1 wealth killer I've ever seen. A buffer is fear hedge. It's what makes you a rational actor in an irrational world. Let's look at Patricia, who retired at 64 with $500,000. She needed $25,000 a year from her portfolio to supplement her Social Security. She put $100,000 into her money market and $400,000 into VTI. When the market dropped 20% in her second year of retirement, she didn't blink. She had 3 years of income sitting in her small tank. She watched her money market go down slowly and predictably while her big tank absorbed the crash and waited for the recovery. Patricia didn't win because she picked a magic fund. She won because she made a structural choice to separate her needs from the market. Moods. This is how you stop the financial displacement of obsessing over tiny fun details while ignoring the massive behavioral traps that actually determine your future. Family, I want you to do 3 practical things this week. First, calculate exactly how much money your portfolio needs to provide each year after your other income sources are counted. That is your need number. Second, multiply that number by 4. That is the target for your small tank. Everything else goes into your big tank. Write down the specific rules for when you will move money from growth to cash. For example, I will only refill my cash tank when the market is up for the year. Having a pre-committed rule short circuits the negotiation your scared brain will try to have with you in the middle of a crisis. Third, pick a broad, cheap index fund and stop over analyzing it. The system does the work, not the specific ticker symbol. The investors who build real, lasting wealth are almost always the most boring people in the room. They don't have a complex thesis, and they didn't catch the bottom. They just set up a simple structure, funded it, and then did approximately nothing for decades. In a country where over half of households have no retirement savings at all, being boring and functional is a massive victory. Lazy investing has built more fortunes than any crypto meme ever will. The system I am describing today costs you next to nothing and fits on a cocktail napkin, but it's the only plan most of us will ever need. It allows you to watch your family grow and enjoy your life without checking a brokerage balance every single morning. The cistern will recover on its own. Family, but only if you give it the time to do its job. This is Imani reminding you that wealth is built step by step. and your peace of mind is part of the profit. If this lesson blessed you today, hit that like button, subscribe to the Imani Invests family, and share this with someone who needs a simple plan to follow. We rebuilding our legacies together, one tank at a time. ILL, see you in the next one.